Hello, everyone. This is John from Delphi Research Team. Together with me today, I have John Wu, president of Ava Labs, the company which creates the Avalanche platform. It's great to host you today, John. How are you?
John, thank you for having me. I'm wonderful, and we read some of your wonderful work. I think you guys do a great job of capturing the deep underlying understanding of not just our technology, but a lot of tech behind a lot of these blockchain products and projects out there. Thank you.
Yeah, thanks for the kind words. I appreciate it. So I have too many questions to ask you. Avalanche is a particularly very exciting project for me. But before I do that, can I have a little bit background on how you entered this ecosystem? I know you have a traditional finance background. Can you walk us through your entry into this ecosystem, please?
Yeah, absolutely. So I started most of my career on the technology investor side. I was part of some pretty well-known hedge funds and funds like Tiger Management, Kingdom Capital. I started my own tech fund that was sponsored by Blackstone. And then in early 2014, I started getting really involved in the space, first in Bitcoin, and I started looking at Bitcoin. Mount Gox had just happened, so Bitcoin crashed. And as a tech investor, I'm always running to something out of curiosity to see what it was all about. And at first, frankly, I'm not sure I really got it, Bitcoin. But simply though, I thought it was a good investment because if you just look at the demand and supply dynamics of it, back then they were releasing X amount, it was only 15 million units that were released back then, I think. And it was like, the price was a few $100s. So if you did the math, like on a daily basis, they were about incremental $1 million worth of Bitcoin was mined a day. And if you track the wallets and look at the addresses and make some minimal assumptions, I just realized there's more than $1 million worth of demand a day here. So it was clear as day that this thing was going to go up as a commodity, supply and demand. I really got into the space though in 2017 when the ICO boom happened. Now, as a professional investor, I've seen my share of IPOs, and I knew what that process was like, how long it took, how much it cost these companies, sometimes $10 million plus, depending on the size of the IPO, and the headache and the mind share it took of these companies to raise money in an IPO manner. So when I saw seemingly like $10 billion worth in 2017, maybe even more, get raised in a crowdfunded manner globally so quickly, I instantly realized, wow, this business model could be fantastic for the entire financial services industry, especially on the fundraising side. The other thing I did notice though was that raise in the US was effectively illegal. The Securities Acts of 1933 and 34 really are pretty clear. And a raise like that required you to have exemptions, whether Reg D or 144A to trade these things. So with that, I was also buying private shares back then. That was Airbnb, Lyft, Uber on a secondary platform called Shares Post. And one thing led to another. I thought that the ATS license they had with the SEC could be also used to help facilitate fundraise and trading of security tokens. I became CEO of the digital assets group at Shares Post. We worked with the SEC. We did a change of membership agreement of that ATS, and we had a commercially viable entity to legally raise money in the way the ICOs were doing it, called a security STO. So I think it was a great tech success, but from a commercial viability, it was still lagging because back then in 17, 18, and 19, if you were a good tech startup, you can just walk down Sand Hill Road and 10 doors are open and help you raise money. But what that showed me though was I realized what I was passionate about and I wanted to be an operator in the space, because when I was a professional investor at some great firms, getting access, getting discovery of great private securities or anything I wanted that was out there, and traversing through the workflow, the regulatory, all of that stuff, and getting access to hard to find stuff was relatively easy to an institution, but to an individual, it's almost impossible. So I saw that the blockchain as a potential way to really, really help smooth out and automate a lot of financial processes. But it needs a powerful, fast, scalable platform. Ava Labs, Eamon Gunsir out of Cornell University, started literally at the consensus protocol layer and figured out what needed to be done to improve and have a more scalable and lower price, as well as a more secure and more decentralized platform, and then created a blockchain architecture. And that's the same mission I was on. Basically, he had the mission of tokenizing or digitizing the world's financial assets, $700 trillion worth of it. And ever since then, we've joined forces. I'm president of Ava Labs, and we're on this mission to make everyone's life hopefully more empowered in a financial sense.
Thank you. Yeah, so a lot of points. So you mentioned your entry and your security tokens. I remember it was such a hype back then in 2018 or so. But then later on, like due to multiple reasons, these security tokens didn't lift off, right? So like the expectations weren't met. So what do you think, like as an expert in this era, what do you think was missing back then, which is not missing now? Why do you think, like in the future, like how you can bring this 700 trillion assets basically in crypto?
So I think there's three things that were missing back then. One was commercial understanding of the power of the blockchain and how it could help disintermediate and make the workflow better. Mm-hmm. People were just learning what the blockchain was back in 17 and 18, frankly. Also, regulation was so unclear, and it took a long time to talk to the SEC in order to get that change of membership agreement. And lastly, to really do this well, I would call it the first types of smart contract chains out there were very good to show the world that, hey, we have programmable contracts now that perhaps Bitcoin was not as good for. But in order to make it really done well, you needed features like speed, scale, and ultimately low cost. And Gun and the team at Ava Labs, who created Avalanche protocol, had the foresight to see this even back then. So the third thing was technology. And I think we're at a stage now where commercially, financial services firms as well as banks are all looking at blockchains to help solve problems for them. Regulatory-wise, we're nowhere close to where we will be, but we are much further along. And in terms of technology, our firm Ava Labs, who created Avalanche, has now really created something I think is very special and powerful enough to really support tokenizing lots of assets and allowing them to exchange on a scale level.
Yeah, that's very exciting. So I know that Avalanche's vision is basically not to like take a market share of existing blockchains. From the get-go, it was built as an interoperability hub, basically allowing many socially or legally bonded validators to run their own blockchains and then have a way for a regulatory compliant fashion, a way to host new financial assets, basically. So can you elaborate on how practically, like what is going to look like in Avalanche in the next months, years or so, when we see like multiple subnets being launched, basically from like a very dumbed down way? What is a subnet? What is like, how does it allow us to have like permissioned and permissionless flows and etc.? Yeah.
Great. That's a great and very insightful there, because the Avalanche platform is uniquely equipped to bring decentralized and institutional financial assets onto one platform. So it has the capability on the permissionless side to support high throughput, low fees, et cetera. And it also supports the regulated cases that financial institutions really need to be compliant. And you mentioned subnets. So the way to think about subnets really is think of it as almost like a permission private blockchain that you can build on top of the underlying permissionless blockchain. And with that, one of the biggest problems I saw in the security token world, working with financial services firms or banks, and that Gun saw from his vantage point, was that these banks or these financial services companies, they had to comply with different laws, different rules, different regulation in different geographies, different asset classes, and they couldn't go to just a simple permissionless entity like a first layer blockchain, because they had to make sure, because their licenses and their ability to survive as a financial institution depended on them being compliant. So call it a private blockchain on top of the Avalanche protocol allows these financial institutions to create the subnetwork of validators where they can determine who can be in that validator and what the rules of being inside are, and effectively create their own governance that can change over time based on the consortium they put in, because they're their guys who actually run some of the subnet. The other thing that's great, and why a lot of financial institutions are talking to us, is because they want to future-proof themselves. They want to be able to say, okay, great, now we can get into this game, if you will, by having a private blockchain, because we want to learn about this and possibly now tokenize funds, tokenize assets in a compliant way. But what happens in 5-10 years? If the permissionless world and the regulation gets clearer, we want to have access to seamlessly plug into the permissionless world. And that's what the Avalanche platform allows you to do. It allows you to seamlessly, almost like turning on an API key, allows that private blockchain to also be part of a permissionless, interoperable ecosystem. The other thing that Avalanche has done very well is it's Ethereum EVM compatible. So, but with the way our blockchain architecture is set up, you can create multiple VMs. So no matter what VM becomes more predominant in the future, we will allow people to be able to work on the environment they want most, or the one that's easiest for them. They can even create their own VM if necessary. And that interoperability between different VMs is something that the Avalanche platform can provide.
Yeah, that's very interesting. So, if we even go one step deeper than that. So, when you have subnets, you can have some validators. Basically, for instance, just to give an example, it could be like real estate brokers in New York running a blockchain, right? And then, do we need an identity mechanism on top of this to enable all this flow and make it a reality? Is this still a missing fundamental part, or maybe other parts as well? Yeah.
That's very insightful, because one of the biggest pains in the system is, and it's necessary to be clear, I'm a proponent of this, especially in the US, is KYC, AML, and accreditation for a lot of these securities. If you don't have accreditation in the US, you're not allowed to invest or transact in certain assets. So if you can create some sort of identity where the person can feel comfortable that they're not giving away all of their PII, but yet get credibility so that they can go invest in certain things, that is an unbelievable solution that one day will encourage more people to get involved. It will create more liquidity for hard to buy assets today, and ultimately better price discovery for the assets themselves. So you mentioned this because I know you wrote a great paper. We have created features in the Avalanche protocol where NTT, non-transferable tokens, where certain credentials, if you're X, then Y will happen. It's like almost programming the rules, not just at the smart contract layer as many other blockchains, but also at the network layer. So when you do that, you have 2 levels of programmability and more flexibility, so that when times change, when rules change, you have the ability to change with it. It's the whole life cycle of the asset you can control.
Yeah, that's fascinating. Could we expect like enterprise use cases soon on Avalanche? Maybe this podcast would be the first time you mentioned.
So the answer is we're working on them.
Yeah.
We have relationships, and the answer is yes. You can assume it relatively soon. I can't, especially with enterprises, it's under strict NDA, so it's hard to just like announce it. But I can give you examples of some of the stuff that we're working on. For instance, there's a large asset management firm who wants to tokenize a new fund on the blockchain. And they want to achieve two things. One, if all their LPs, the auditors or third-party service providers themselves as the GP, the accounting, the transfer agents, all of those third-party service providers are in the same blockchain, they've calculated that they can smooth out the workflow, decrease the technology, and you can save, 2-3% in terms of just automation. Now, that's a lot when you're talking about a large asset management firm that can be, billions of dollars, especially if you can raise $1 billion or $2 billion fund. It adds up. It's like $20-30 million you could save. Another benefit they see this now is if it's a closed loop blockchain or a private blockchain where the LPs are connected, the rules are different from a permissionless blockchain. So now these LPs actually can trade LP units with each other in a there's still rules that you have to follow, but it's a less restrictive rule set. So that's a huge benefit for their LPs if they wanted to be on the blockchain. So that's an example of something, we're working on. Another thing that we're working on with financial services firms is we've all heard about the infrastructure bill coming around in the US. So the anticipation is there is this giant construction loan market out there. It's a very OTC, over-the-counter market. There's no like a New York Stock Exchange where all this stuff trades. And sometimes the discovery for the price as well as access to these loans is not the easiest thing. So if you are a fund specializing in this, you have like the inside track to know where and how to price this up. But it's not easy for everyone to get access to this stuff. And sometimes there's great return, and the risk-adjusted return is incredible on some of this stuff. So there is a bank working to digitize or tokenize some of these and create a marketplace in a regulatory compliant way. That's another example of how applying, blockchain or Avalanche protocol technology to new use cases, I would say, and to make an existing market that much more efficient.
Yeah, thank you for these insights. So how do you see the current market right now? We've been through summer DeFi and then a institutional driven bull market. Maybe we're in a bear market now. So a lot of things are moving. I'm like having a hard time keeping track of it actually. But I want to ask you about, especially with regards to like institutions' attitude towards crypto. We see like in this year, a PayPal, Revolut, MicroStrategy, Square, they're all one way or another adopting or supporting cryptocurrencies. And so do you think this trend to continue even further? Are we going to see like S&P 500 companies having cryptocurrencies in their balance sheet a common norm in the future? How soon are we there?
Well, first of all, I hope so is the answer.
Yeah.
And I do see it increasing over time. So these, call it enterprises, or, MicroStrategy is not a financial services firm, but these enterprises they first got into it as putting them on their treasury, on their balance sheet. So as almost like an investment or diversifying their portfolio of assets for treasury. And then we saw the players like PayPal, who are enabling more people, and Square and Revolut, enabling more people access to cryptocurrencies and Bitcoin. Now, the institutions like hedge funds, private equity firms, those people are now looking at this not just for the store value hedge on inflation, but what they're seeing, especially if they're in the financial services game, they're realizing the potential utility of blockchains and the cryptocurrencies. They are actually trying to get ahead of the curve, future-proof themselves. They've seen what Amazon did to e-commerce. They don't want the same thing to happen to themselves. So they are actively looking at use cases, and we're beginning to see use cases. You know, I know we're going to be talking about DeFi. DeFi is an incredible use case. At its peak, it had well over $100 billion in TVL. It's a little bit lower now because of the price. However, even with this sell-off recently, if you look at the unique visitors or number of wallets created in the DeFi ecosystem, it has been going up, even though prices have coming down. So use case has actually increased even in the down market for the prices. So just like the last cycle, and I'm not saying we're in a bear market, no one really knows for sure, but down markets are actually great times for companies to really focus on operating and developing and creating more good technology. And the beautiful thing about this time around versus 18 in the last winter is that in the 18, your use case was ICO and it kind of disappeared. Now there's many use cases, not just DeFi, there's NFT, enterprises are also using it for private blockchain. So use cases are increasing, utilities increasing, even if prices go down.
Yeah, that's a great point, actually. You just see how like people value this benefit, and then like with blockchain, you have all these cool stuff, and then yeah, it's very sticky. Like once you get in, you don't go out. But new people always keep coming, and then the pie is just growing. So and with that, like you basically see a lot of fees going really overblown, right? So a lot of retail users getting overpriced by whales in the DeFi world, and then they basically cannot transact anymore. And that's a part of the reason why we see also many other solutions, layer ones and layer twos.
That's correct. I mean, and this next generation, I call it the third generation of blockchains or first layers. They saw that the previous generation of blockchains were missing certain characteristics, and you're effectively talking about capacity. And lack of a capacity will increase prices. And there were people out there who were buying $10 NFTs but paying $80 of gas prices. That's not something anyone wants to do. So beneficiaries of that were other first layer protocols. Avalanche was a beneficiary of that because of the lower prices. That was very important. And I think, you went to this point earlier. We don't consider ourselves as an Ethereum competitor. We see ourselves as like an Ethereum complement. There are certain features and functions that they can do in the Avalanche ecosystem, and where everyone knows Ethereum is still the granddaddy of them all. It's the biggest place. So it's kind of like saying, where our firm is in Williamsburg in Brooklyn, but it's kind of like that bridge to Manhattan. If you want to wear a nice jacket and nice shoes, leather shoes, and go out and pay a high-priced dinner with some drinks, you go to Manhattan and maybe you go see a show. If you want to go put on your Birkenstock, a t-shirt, just cross that bridge, go to Williamsburg. The prices are still high, but you can have a more chill environment and have a different type of dinner. So it's just different. It's not like Williamsburg is really competing with Manhattan. It's a different flavor, and having the right bridges and interoperability will allow different assets and different users to try different things and developers to develop different things. A person who's creating a restaurant in Williamsburg is going to create a different vibe than the person who creates a Manhattan, Midtown, Wall Street oriented restaurant.
So talking about like Manhattan and bridges, like how much does it cost to bridge over? So because I know like the Ethereum bridge, it attracted a lot of liquidity, and then at times it was also costly to cross over, and it was also not necessarily a very fast experience. And I know that you're doing some developments there. Could you talk a little about like bridges to Avalanche and how you're planning to port over new
Right.
liquidity?
Yep. So you're referring to one of the bridges, the community-led bridge from Ethereum to Avalanche. We're very grateful that the community thought it was important enough to create a bridge in order to have assets move back and forth. But you're right, because the way it's set up, done by the community in good, faith, and the way the fees are set up, you have to pay, two sets of fees effectively, one on one side of the bridge and one on the other side of the bridge. So again, Avalanche cannot affect the price on the other side of the bridge, only on the side that's on Avalanche. So I think if you look at the fee imbalance, it was really one side that made it more expensive. And then in terms of functionality and difficulty, when you have these community-led projects done really quickly, as much as it's appreciated, it's never going to be perfect. However, I can tell you that there are some things that are being worked on right now that will make that experience 1,000 times better and at least 100 times, if not more, cheaper. So both your concerns are being addressed, and that's all I can say right now, but it's not too far before you can see it for yourself.
I'm obviously like comfortable with the technical advantages of Avalanche, but I'd like to also like talk about it because like viewers may not necessarily know it. So like what's super impressive for me is obviously how you can scale in the size of validators validating and securing Avalanche. It's really not realistic to expect like 100 or so validators to validate web scale applications over the long term. Another big advantage is obviously the near instant finality. Like so if there's like one thing that I'm certain about crypto is that like moving forward 10 years from now, people are not going to like prefer a slower blockchain. So yeah, that's like, and if you ask like any distributed systems engineer, they'll tell that like finality is the hardest problem. Like throughput is not as much. But yeah, so how do you think about these advantages, like showing themselves and then basically benefiting Avalanche community in the future?
Yeah, absolutely. You're right. But all of those advantages go hand in hand to provide a lower price for transaction. That's the ultimate advantage that everyone wants. But the reason why Avalanche has this advantage is because Ava Labs, who is a well-known distributed systems professor and it's well-known in the space for a long time from Cornell University, he realized that if you really want to provide that perfect environment, you have to actually go from the very ground up and recreate things. So in the history of consensus protocols, there's been the classical, and then there is the Nakamoto. Obviously the classic, it's like 100, maybe 200 at most validators. And you quickly run into various problems in terms of more decentralization and more distributed if that was the problem there. Frankly, I think ETH 2.0 and a lot of private blockchains are still running under that consensus protocol. Then you had the Nakamoto, the longest chain, which had its own issues. So what Gun said, well, how do we figure out how to provide the enhancements? And instead of just like using one of the existing consensus protocols and then changing the blockchain architecture, Avalanche is one of the few blockchains out there where I think it's a different paradigm in terms of consensus protocol. It's a subsampling methodology. Whenever you do this, there is some minor trade-offs, but with a lot of math and deep proofs, you realize that the trade-offs are so small that you can create basically an environment where the security is still incredible, especially when it's so decentralized with, as you said, a lot of validators. In fact, there's over 1,000 validators on the Avalanche protocol. No other blockchain first layer can honestly say that. And I think that is a huge advantage, especially in a world where we want to see some distributed and decentralized governance. So it starts with not just the blockchain architecture, it started with Avalanche all the way at the consensus protocol level. Innovation is what Gun is all about, and he started at the most basic level instead of reconfiguring a blockchain architecture to try to solve some of those problems. But he solved it from the very base layer.
Yeah, that's very respectful. I mean, like crypto world can be full of copycats and all that, and Avalanche is a truly innovative ecosystem altogether. So moving forward, what should we expect in Avalanche? I know there's two main upgrades. First the apricot and then the blueberry, I think it's called. So what do they signify? Could you talk a little bit about that?
Sure.
Yeah.
So for the less technical audience you have, these two upgrades, think of it as similar to your iPhone. When you get a message at night, there's a software upgrade, you gotta leave it on, and then they fix patches or they improve the speed of the operating system so your iPhone can work better in the morning. This is similar. All blockchains have similar constant upgrades. Yes, you mentioned two big initiatives on the technology side, and these upgrades will ultimately attribute to some incredible improvements in the underlying platform, including, we talked about this already, make the subnetwork environment a reality. And that is literally just not that far away. Then there's all these other things, such as like dynamic fees involved in this, where all of a sudden, the fee structure will go down even more. So there's a lot of this functionality in these two, call it named upgrades. That's what's happening on the technology side. We're really looking forward to that and very excited about that. On the business side, there are over 50 live dApps already in the ecosystem. And it's very important to recognize that the Lego pieces that allow a DeFi community to really grow are just getting to the point where we're ready for liftoff velocity. And these dApps that have launched on the Avalanche platform, they have done it not because we threw money in massive incentive programs. They've done it because we've led with tech innovation, and they really just genuinely, developers wanted to try it out. So now that the Lego pieces are almost there, the structure of DeFi, you need stable coins, you need AMMs, you need lending, you need maybe yield aggregators, maybe derivatives, indexes, insurance. All of those things are now starting to land on the Avalanche protocol. And when that system is ready to go, all the pieces are ready to go, there will be certain incentive programs that Avalanche will give out there that will incentivize people to really try out the bridge and try out the other restaurants across the bridge, so to speak, if we go back to that Williamsburg example. And we're very excited about that on the business side. Also, I did mention this earlier, and I can't name it, but there are some enterprise partnerships that will also be announced this summer. So lots of tech improvement, lots of, call it permissionless business development improvements, and then the enterprise private blockchain side. So it's a very exciting time to be at Avalanche.
Sweet, that's great to hear. John, I want to also ask you about how you see the current regulation in crypto. So, I mean, lots of developments, but it's hard to keep track. Now, I know like OCC allows banks to hold custody of funds. There's new regulation that's coming, Stable Act. Do you have any insight into what that implies for crypto as a whole, and how you see the space evolving in the next months?
Yep, I think those are very important points, and I'm glad you brought it up because as we talked about earlier, the regulatory environment has improved since the mid 2010s, the 15 to 18 time period where there was just so much uncertainty and people had no idea, and the regulators had no idea what the technology was about. There has been a lot more cases and a lot more understanding. The regulators have given more guidance, whether it is banking related, money transmitted related, or SEC securities related. However, in fairness, we are still kind of a long ways away for full clarity. So the one thing that every DeFi project is trying to figure out is, how do you define decentralization? What is decentralization? Because a lot of the securities rules that they are not enforcing or not complying with is primarily because they feel like they're decentralized. What entity? How do you go after people if people are just doing things? It's kind of a weird construct. So I don't know if anyone could ever say regulation is kind of like a paradigm shift and just goes from one level to another. In this space, it's going to be evolutionary. And the most important thing for projects and for first layer protocols like Avalanche to do is always to make sure that they are nowhere near the gray zone and comply as much as possible. And then they should hopefully not have to worry about anything. And reality is the space, although it's like a peaked out about 1.5, 1.7 trillion, it is still tiny compared to equities, debt, where each one of those asset classes are anywhere from $300 to $600 trillion. So Gensler and the new SEC and other regulators are still more worried about, I think, other things from SPACs to all these other, regulatory related issues. But they are definitely more focused than ever. And I think ultimately that's helpful. And the whole community should actually embrace more guidance.
Yeah, that's really helpful. Thank you for that. With that, I think, those are the points that I want to bring it to you. So do you have any other comments that you want to make before we finalize this podcast?
Yeah, I do want to bring up one more comment. I think you mentioned price and institutions coming into this space. And if you look at the amount that's custody, just look at Coinbase, for instance. A year ago, maybe a year and a half ago, I would say their assets under custody, AUC, was probably 70-30 retail versus institution. Mm-hmm. Today, it's probably more like 40% retail, 60% institution, if the ratio is not even more towards institution, because institution dollars are much more. It's no longer just hedge funds. It's now possibly pensions and endowments. So as there's more interest in this space, what I've seen, which is very important, more smart young people are entering this space. Young people like yourself who find it fascinating, whether it's the mission or the technology that they get to be part of. With great people coming into the space, a lot of the issues you've highlighted here will be solved. I remember when I was a young guy and we were looking at the internet, and there were people saying, one day we're going to have video streamed over your PC. You're going to watch a movie on your PC. And all the smartest of the smart technology venture, as well as public equity investors, did the math and said that's absolutely impossible. The cost to digitize the film, the cost to send it through the pipes, the time it took, you might as well just go to bed, turn on your computer, start downloading the film, and pray that there's no disruption so that in the morning you can see the film. Well, no one can figure out how it's going to get done, but 15 years later, Netflix showed everyone that it will get done. And that's because there were a lot of smart people entering the space, whether it's engineering, business, economics, you name it. Same thing is happening here. Whatever you can imagine, the best is in the future, and it's to come.
Yeah, I can't agree more with you on that point. Thank you for taking time to join and share your thoughts here. It was really insightful. and really helpful. And wish you all the best luck in the future.
Thank you, John. A pleasure.